Sunil Garg joins us right now from JPMorgan to chat about his thoughts on the market. Sunil, hi, morning. What's your outlook, firstly, on the US economy and further quantitative easing?
As far as the US economy is concerned, our expectation is that the recovery is evolving on its own course. There's definitely some bumps across. I think recent statements from the Fed did talk a little bit about a delayed interest rate increase, and I think that's a good guidance to read here. I think away from tapering, which is now proceeding along a pretty well-flagged path, I think the biggest question to focus on is the pace of monetary policy normalization, as in short-term interest rates. Now, again, the Fed's recent statements did talk about staying lower for longer, and that should, I think, support the markets. I do think, though, the Fed's going to be very data-dependent, and if we do see some of the slack being taken up in the economy, you will start to see policy getting normalized earlier. But at this point in time, it's fair to expect that the policy will remain accommodative for now, and that's the main focus, as in short-term interest rates.
So, Sunil, what is your view on the impact of quantitative easing and taper and interest rates on Indian rupee and debt flows? Do you see strong foreign flows to continue in Indian equities?
See, first of all, if you look at the interest rate outlook in India, our economists are calling for a non-consensus increase of 50 basis points in the second half this year. Obviously, a lot of this is going to be dependent on how inflation evolves and how the macro variables evolve after the elections. But at this point in time, that is the expectation. Having said all of that, I think one of the biggest tailwinds for the country is a stronger currency, which helps give some flexibility to the Reserve Bank of India. Our expectation on flows is that it's going to be not very QE dependent or dependent on external macro variables as it was last year, but it's going to be a lot more dependent on domestic factors. And, we've definitely seen very strong inflows on a year-to-date basis. Last few days have definitely seen some consolidation. And you could probably see some more consolidation ahead of the election results in a couple of weeks' time. But in general, we're positive on flows continuing into India as we get into a cyclical recovery.
Right. Sunil, so, you're expecting decent fund flows into India. What about its Asian and emerging market peers? Will they stand to attract more foreign flows?
So I think the clearest beneficiary, in addition to India, we see in the flows is Southeast Asia. So Indonesia has seen a turnaround as far as portfolio flows are concerned. We do think that there are opportunities in Philippines and Thailand as well. So ASEAN and India seem to be best positioned to attract flows in our view.
Sunil, India currently faces two challenges: election risk and risk of a poor monsoon. How would you plan to prepare for these risks in the context of sectoral allocation in Indian stocks?
Look, if you look at the broad market index, it is trading at all-time highs despite some of these risks. But what's very interesting is that the market has been led by either defensive sectors or global growth plays such as IT services and some of the automobile names which have a linkage to the foreign operations. My expectation at this point in time is that as we get past the election uncertainty, whatever be the outcome, we should be focusing a lot more on the domestic economy and cyclicals to play that recovery. Obviously, you can have elections or any other natural forces being a risk to these. So to that extent, I think over the next few weeks, my expectation is that investors will remain defensive, but once we get to see the election outcome and remove that overhang, we should be moving back into risk and back into cyclicals, in my view.
Right. Sunil, the banking sector has seen a good run-up. How will you play banking as well as NBFC names now?
So if you look at the recovery, let's take the PSUs, for example. The PSU banks are up 25-30% from the lows, but in the context of how much they've declined, I think there is a lot more upside for some of the selective PSU names. Now, if we do look at the macro environment for a minute and still see some risk of interest rate increases, I think deposit franchises are where you want to be, which means you want to be in banks as opposed to NBFCs. That's definitely a preferred positioning. Within the banks, definitely PSUs offer cheap valuations, and I think some of them selectively look attractive, and we continue to like some of the private names, but very clear distinction and bias in favor of the banks as opposed to NBFCs.
Sunil, the investment climate and infra sector has taken a beating. How would you play into infra sector, and what is your take on capital goods stocks?
So, on one hand, I'm talking about a cyclical recovery. So, the obvious question is, do you buy beaten down infrastructure stocks? My view is that rather than just focus on the earnings recovery, one should also be looking at the balance sheet problems which are there with a lot of infrastructure companies. And I think a cyclical revival is not going to be enough on its own to revive the fortunes of some of the infrastructure companies. So I think there are cleaner ways to play a cyclical revival, and that you can find in things like commercial vehicles, in cement, in some of the metals and mining names, as opposed to going and playing the infrastructure sector in general. Obviously, selectively, there will be companies which have de-geared or have taken steps to deleverage their balance sheets. Those would be attractive, but I think cleaner plays would be in cement, some of the steel names, and also the commercial vehicles.
So what is your outlook on the RBI policy in future and its impact on banks over the next 1 year?
So as I mentioned, we do have a non-consensus expectation of 50 basis point rate hike over the second half. And I think, again, given where the inflation pressures are, I think it's better to be with deposit franchises. And we do like, as I said, some of the PSU banks and also some of the private sector banks. But banks over NBFCs is where we would be.